Wait, give me a few seconds. Today I discuss the liquidity. Hmm, wait. Hi, dear audience, dear viewers. Um, this is my new YouTube channel, Web3 Elite Academy. Actually, this channel is dedicated for MQL4, MQL5, and Python coding tutorials. But sometimes I create some videos relating to different strategies that traders prefer to implement in their trading system, in their day-to-day trading. So today, my topic is liquidity forex strategy. So trading, liquidity is the oxygen of trading. Liquidity forex trading strategy is very important, is extremely important, because without liquidity, forex trading does not exist. So forex trading revolves around liquidity, the ability to buy or sell assets without significantly affecting their price. Oh, sorry. Forex trading revolves around liquidity. Liquidity is the ability to buy or sell assets without significantly affecting their price. Means if you have the liquidity, it will not significantly affect the execution price. So if you want to execute a price at a certain level, and if you don't get that price, it becomes really difficult for you to stay in the field. So liquidity is important. Understanding liquidity is crucial for traders who are aiming to optimize their strategies and minimize slippages. So, slippage is also an important part of trading. If your slippage is big, then it will be difficult for you to make profit. So, liquidity forex trading strategy focuses on how traders can leverage liquidity zones, order flow, and institutional behavior to maximize profitability. So, three things: liquidity zones. If you search Google, you'll find how to detect liquidity zones. This is nothing new. And order flow, there are many indicators on order flow. You can search in TradingView. And institutional behavior to maximize profitability. So first of all, you have to find out the liquidity zones. You need to identify the order flow and institutional behavior. You need to identify the institutional behavior when they move the price. Okay. Liquidity in Forex refers to the ease with which a currency pair can be traded without causing drastic price fluctuations. I have repeated this. The major currency pairs like Euro USD, GBP USD, USD JPY tend to have higher liquidity due to the larger number of market participants involved. Because of the large number of market participants involved, high liquidity means tighter spreads, lower trading costs, and smooth price movements. So high liquidity involves tighter spreads, lower trading costs, and smoother price movements. High liquidity is important for good trading environment. So now I'll discuss key components of a liquidity-based trading strategy. So first of all, you need to identify the liquidity zone. Let me tell you some features so that you can easily identify the liquidity zones. Liquidity zones are the areas where a large number of buy and sell orders are placed. It means when market has the highest volume. These are usually found at these liquidity areas are found at support and resistance levels. If you don't know how to plot support and resistance, look at some all traditional indicators. You can easily find it. Or go to babybeeps.com. You'll know how to plot support and resistance levels. And also psychological levels. That is round numbers. Round numbers. You can also check previous swing highs and lows. So support and resistance levels, round numbers, and previous swing highs and swing lows will tell you about the liquidity zones. So institutional traders actually try to stop hunt at those areas, support and resistance levels, previous swing highs and lows, and institutional price levels. Market makers and institutional traders often trigger stop loss orders to create liquidity for their large positions. Traders can identify these stop hunt zones by looking at areas where the retail traders commonly place stop losses, just below support levels or above resistance levels. Traders can identify these stop hunt zones by looking at areas where retail traders commonly place their stop losses, just below support levels or above resistance levels. Another way is to use order flow concept. Institutional traders accumulate large positions over time, causing price imbalances. If you watch order flow, watching order flow via tools like volume profile and footprint charts helps in understanding where large players are positioned. So if you can identify where large players are playing, you can find out the liquidity zone. And you can also use the smart money concepts. Smart money, banks and institutional traders. Smart money means banks and institutional traders moves the market by targeting liquidity pools. A liquidity grab occurs when price temporarily breaks a key level before reversing. Traders can use this concept to enter trades at optimal points. Another thing is timing and session liquidity. Liquidity fluctuates throughout the trading day. Liquidity is not linear during the day. It fluctuates. It goes up and down. London and New York overlap. Highest liquidity and volatility is seen in London and New York overlap. This is really important time. So Asian session, lower liquidity, good for range bound strategies. In Asian session, it's good for range bound strategies. End of New York session, liquidity declines, leading to slower price movements. So understanding timing and session is important to understand liquidity. Now let me talk about how to apply liquidity in Forex trading strategy. It can be automated or it can be manual. If you follow certain steps, you can apply liquidity trading strategy in your Forex trading. Number one, identify key liquidity zones. I told you earlier about the liquidity zones, how you can identify liquidity zones. So first of all, identify key liquidity zones. Mark major support and resistance levels. Use historical price action to find liquidity pockets, liquidity buckets. Two things. Mark major support and resistance levels. Watch historical price action to find liquidity. Secondly, look for false breakouts and aggressive wicks, big wicks. Identify large institutional moves before reversals. So before the reversal, you'll see some big moves. If you look at the candles, you can identify the big moves. So look at those institutional moves. Step 3, confirm entries with volume and order flow. Look at the volume profile, look at the volume and order flow. You can use different indicators. You can read the charts. You can understand from the candlesticks. I may produce some videos regarding how to identify them in future. And step 4, enter and manage the trade. Enter after liquidity grabs to avoid stop hunting. Place stop loss orders strategically below liquidity pools. So try liquidity area as a zone and put your stop loss below the liquidity pool. It depends every time on the setup, current situation of the market. Exit near opposing liquidity zones for optimal risk reward. So you also have to know when to exit from your trades so that you don't run into a trap. So finally, what I should say, identify key liquidity zones, watch for liquidity, false breakouts, aggressive wicks, and confirm entries with order flow. Look for high volume spikes, which are signs of institutional participation, and enter and manage the trades. So finally, a liquidity forex trading strategy provides traders with an edge by following the footprints of the institutional players. So liquidity forex strategy means you are following the institutional traders, institutional players. You are focusing on the liquidity zones, order flow, and smart money movements. Traders can make informed decisions only looking at the charts and increase profitability. Mastering liquidity dynamics can take time, but with consistent practice and the right tools, traders can significantly improve their market performance. To speed up your execution and to make your execution precise, you can take the help of automated trading. Thank you to watch my liquidity forex strategy video.